Welcome back, focused learners, to another explainer. Today, we're looking at something absolutely unprecedented in modern American economic history. Seriously, a brand new reality took hold in 2025. U.S. tax dollars are now actively entering the private stock market. We're talking about the federal government stepping in as a direct investor in publicly traded companies. It is a massive paradigm shift. So today, we're going to use historical data to break down exactly what this means for the economy, for the markets, and of course for you.
Okay, let's dive into this. What actually happens when a government just starts buying up its own country's stock market? It's basically the multi-trillion-dollar question on everyone's mind right now. And rather than just guessing or throwing wild predictions at you, we're going to establish our analytical premise by looking at hard history. Because, while we haven't seen this happen during peacetime in the US before, other countries have run this exact playbook. And the results? Well, some built absolute economic powerhouses, while others, they bought themselves decades of devastating economic stagnation.
Section 1. The Present Shock and the U.S. government's new investment strategy.
So this new strategy is already in motion. Back in 2025, the administration allocated billions of tax dollars to directly invest in specific companies. The big ones were Intel, MP Materials, and Lithium Americas. And what happened next? Following those massive injections of federal capital, the stock prices of these publicly traded companies absolutely surged. The facts are pretty clear here. The government is taking an active financial stake in the private sector. Now, to really understand where this is heading, we need to look at the vehicle driving the whole thing, which is a sovereign wealth fund. Think of it as a giant national investment account managed by the government and funded by your tax dollars. Right now, there's a strong proposal to establish a formalized U.S. sovereign wealth fund by 2026. Adding to that momentum, a new Federal Reserve Chairman, Kevin Warsh, takes over on May 15th, which could potentially open the door to monetary policies that help fund these investments. Plus, there's a bill moving through Congress right now designed to officially codify this practice. If that passes, it would become standard law for the U.S. government to take equity stakes in private companies. It's a real game changer.
Section 2. The Build Path and Singapore's Economic Growth Engine. Let's move to and see how this builds. There are basically two distinct paths a country can take when they deploy this kind of capital. Path 1 is the build strategy, and it was famously executed by Singapore. Now, instead of just throwing money at the broad market, the Singaporean government strategically targeted and invested in specific companies. They picked the ones they truly believed could scale up and drive their entire national economy forward. They were literally building high-growth industries from the ground up. And the results of this targeted strategy? They were nothing short of staggering. This approach fueled a massive 12x explosion in their GDP per capita. To put that into perspective, back in 1980, the average person in Singapore generated about $5,510 for the broader economy. Fast forward to 2024, that number skyrocketed to $67,760. By strategically investing those tax dollars to scale critical industries, the government effectively multiplied the nation's economic output by 12.
But you might be wondering, how did that actually impact the everyday citizen? Over 4 decades of growth, the wealth didn't just stay locked up at the corporate level. While the GDP per capita jumped 12x, the broader stock market also grew 3x over those decades. And most importantly for the everyday worker, when you adjust for inflation, the real take-home wages in Singapore completely tripled. So the Build playbook successfully created this incredible virtuous cycle: corporate growth, market expansion, and genuinely rising personal wealth for the citizens.
Section 3. The Prop-Up Path and Japan's Cautionary Tale.
Right, so there's absolutely another side to this coin. Unlike Singapore, the Japanese government aimed to boost, not build. They basically flooded the broad market with cash. Their goal was to artificially prop up general stock indexes and just keep prices high. Well, the macroeconomic fallout from this artificial propping up was pretty severe. Instead of creating a boom, Japan experienced a brutal economic contraction. Over a roughly 30-year period, their GDP per capita actually fell by 16%. It dropped from $44,000 back in 1995 down to $37,000 in 2024. And unlike Singapore, the everyday citizen paid a massive price. Real wages in Japan fell by around 11% during that exact same period. It's honestly one of the only times in modern history a developed nation saw wages shrink over 3 consecutive decades.
And this brilliantly illustrates the sheer devastating length of that economic stagnation. Look at this. They hit a dizzying record high in 1989 right as these interventions were happening. But then, the momentum just stopped. Through the 2000s, it was total stagnation. By 2010, zero meaningful recovery. It wasn't until 2024, a full 35 years later, that the Japanese stock market finally broke that 1989 record again. So a policy that was meant to superficially prop up the market ended up costing the country 3.5 decades of lost growth. Just wild.
Section 4. The U.S. Hybrid Reality, and Which Path for America? Bringing this all back to the present day, we're currently living in what you'd call a U.S. hybrid reality. We are seeing some seriously conflicting signals coming out of the current administration, which makes it incredibly difficult to pinpoint exactly what the long-term macroeconomic outcome is going to be. Because we aren't neatly following the Singapore model, nor are we strictly copying the Japan model. We're kind of showing signs of both. On one hand, we clearly see elements of the build strategy. I mean, the investments in Intel, MP materials, and discussions around funding defense infrastructure, that shows a targeted desire to build up critical domestic supply chains. But on the other hand, discussions around a potential federal bailout for struggling companies like Spirit Airlines, well, that looks alarmingly similar to Japan's prop-up strategy. Saving failing entities just to keep the market afloat. This hybrid approach leaves the ultimate future of the U.S. economy highly uncertain.
Section 5. Strategies for everyday investors and the if-then matrix. So the crucial point is, what do you actually do with this information?
Because the U.S. path is so uncertain right now, we can use history to build a framework. If you fear we're heading for a Japanese-style stagnation, history points toward value and dividend stocks, like the SCHD fund, for example, that pay you cash regardless of overall market growth. On the flip side, if you're betting on the Singapore build model taking hold, you might look toward defense and infrastructure, perhaps through an aerospace and defense ETF like ITA. Want to avoid U.S. uncertainty entirely? You could diversify internationally with funds like VEA for developed nations or VWO for emerging ones. Or, hey, if you simply believe the American economic engine is going to win out no matter what they do, you just stick to the broad S&P 500 with something like SPY.
Now, just a brief but absolutely vital reminder as you look at these frameworks. Investing inherently involves risk. The historical precedents of Singapore and Japan are incredibly useful lenses for learning how to think like an investor, but they aren't direct financial advice or guarantees of future performance. Always do your own thorough due diligence before putting your hard-earned money into the market.
We're entering completely uncharted waters for the American economy, and it's all happening against a backdrop of immense global fragility. As the president of China recently stated, the international order is crumbling into disarray. With rising geopolitical instability worldwide and the unprecedented move of the U.S. government injecting tax dollars directly into its own private stock market, the rules of the global economy are changing right before our eyes. So will the U.S. build an unstoppable engine of future growth, or will it just buy its way into a lost decade? That is the profound question we leave you pondering today. Thanks for joining me on this explainer, and keep learning.